Hello, today is Tuesday, August 19th, and today we're going to be looking at the SPX Index Daily Key Levels Indicator and using it to trade 0 DTE options on the SPX Index. So up on the chart we have today's session of the SPX Index. This is a 2-minute chart, and the SPX Index Daily Key Levels Indicator is meant to use on, as far as day trading, is on time frames of 1 minute, 2 minute, 3 minute, 5 minute, or up to 10-minute chart time frames. My preferred chart time frames for using it are 1 minute, 2 minute, or 5 minute. The majority of the time I use the 2-minute chart. Alright, so every day at 9:30 at the open, the indicator will give you the bull bear key price level. This is going to be your important bull bear pivot for the session, and this marks the defining line between bull and bear for this particular session. So every day there's going to be a different bull bear key price level. So here we have key price level abbreviated as KPL, and we'll also be referring to it in some of the text here as BBKPL. Alright, so your levels above the BBKPL and below the BBKPL are primarily your take profit levels as well as stop loss levels, depending on what type of entry that you're using. So for example, on today's entry, on the 9:30 candle, we had a cross below and a close below the bull bear key price level on the opening candle. So here we would take a 64.45 put entry because that is the closest strike to the bull bear key price level for today. So we'll be using an at the money option, in this case 64.45. So you would take an entry here on the price cross and close below. The entry on this would be $10.60 as we're buying on the close. However, you could buy intra-candle and get a better price. However, most of the time it's more prudent to wait for the close of the candle because it could reverse, and before the candle close it could reverse and actually close above it. So typically, especially on the opening candle, it's best to wait for the candle close. Okay, so the first level above on a put entry, which is a bearish entry, your stop loss level is going to, your standard stop loss level is going to be this midpoint level here. So on this indicator, you have the main levels here. So we have the bull bear key price level, we have R1 and R2. There's actually, this indicator goes up to R6. And below that you have S1, S2, S3, and it goes all the way down to S6. The midpoint levels are primarily used for gauging momentum and also for stop losses, primarily off of the bull bear key price level. Because most of your entries are going to be in the morning, and usually in the morning it's going to be an entry off of this bull bear key price level, either a bullish entry or a bearish entry. So on a bearish entry taken that's triggered from this bull bear key price level, your standard stop loss is going to be the midpoint, the first midpoint above, which would be mid BBKPL R1. So this would be your stop loss here on this particular entry. If you wanted to use a tighter stop loss, it would be the first quarter level above, which would be the midpoint between here and here. Most of the time it's best to use the standard stop loss on most entries, but everyone is different and people's risk tolerances are different. So if you have less of a risk tolerance, then you could use, and you wanted to use a tight stop loss, then you would use the quarter level above. In this case we use the standard stop loss, and in this case, as you can see, although we did get an initial move down, it stopped short of S1, reversed, went back up, and of course we have our stop loss here, So we haven't hit the stop loss yet. And after some more gyrations here, it eventually does hit our stop loss here on the 10:02 candle. The stop loss was hit on trade 1. The 64.45 put low of this candle here was $5.30. So we're going to assume here that we got out at the low of this candle from it hitting the bull bear KPL R1 midpoint here, although it did go a little bit above it. So the loss here is $530 a contract because you're out at 530 and your cost was 1060. Okay, and now we're going to wait for another entry. Since this was the initial thrust down, we're going to be looking for another bearish entry for today. Here we have a close below. Then we're looking for, at this point, since we've gone through the initial thrust down, now we're looking for additional confirmation. So we don't get that here, but then we get another down candle here, and then we get a confirmation candle here. So this is your second entry here on the 1036 candle. So again, 64.45 put entry. This is entry number 2. On this particular candle, the candle closed, the put was $8. So the standard SL again is the first midpoint above the BBKPL. We're also going to take a look at the Thinkorswim option charts so we can validate all these prices, and we also have all the timestamps so you'll be able to follow along when we reference this back to this chart again. Okay, so we're in this entry here. As you can see, the SL was never hit on trade 2. And in fact, if you used a tighter stop loss, the quarter level, it would not have been hit on this trade either. So keep in mind, if you did use the tighter stop loss on this particular first trade, then your loss would have been less because your stop loss would have actually gotten hit here earlier. But since we used the standard stop loss, it did not hit it here, but it did hit it here. So our second entry here, we have a nice stair step down, and then we have a touch of the S1 level here on the 1048 through 1050 AM candles. So XPX hits our S1 level here. The 64.45 put that we bought at 8 is now 1550 on the close of this candle. If you're trading multiple contracts, you can consider at this point at the S1 level to close out between 70 to 90% of them at S1 and adjust the stop loss on remaining runners. If you're just trading one contract, then when it hits S1, you can consider going ahead and changing your stop loss to the entry price here. So you could go ahead and move the stop loss down to this level here by simply just going ahead and putting your stop loss at break even, which is the cost of the trade. Okay, so after a short move up here, we get a violent move down in these 3 candles, which spans just 6 minutes here. So we move down from about 64.36, 64.37, all the way to about 64.20 in just 6 minutes. So on the 11 a.m. candle, XPX hits the S2 level here. The 64.45 put that we bought at 8 is now $25. This is where you would close out and take your profit on trade 2. So this is where you would, if you were just trading one contract, you would go ahead and close that out here. If you were trading multiple contracts and you had not done any runners and already closed out 70 to 90%, then you would definitely want to close out all contracts here, because this is basically a 2-level move. On most days, that's what you're going to see as the take profit on SPX is two level moves either below the bull bear key price level or above the bull bear key price level. So it's most prudent to go ahead and close out when you get a touch or a strike through the level. Go ahead and close out all of your contracts. The only exception to that would be if you already closed out 70 to 90% of them here at the S1 level and you had adjusted your stop loss and just kept a minority of your position for runners. You could of course still close out the runners here, but in most cases when you are running doing runners and taking the majority of your profits earlier, in most cases you're also looking to get a larger move, because we don't know if this is going to end up being a move that could go all the way down to S3, S4, S5, or even S6. So the whole point with runners is collecting profits as they happen on the way down, adjusting your stop loss so you're locking in either break even on the remaining runners or locking in partial profits on the remaining runners, which would be somewhere between 10 to 30% of your contracts. So for example, if you were trading 10 contracts, 70% would be selling 7 of them, 90% would be selling 9 of them. If you had been trading 5 contracts, then selling 4 of them would be 80%. If you had 3 contracts, if you sell 2 of them, that's almost 70%. It's 2/3 of them. So that's basically 66.66%. If you had 20 contracts, then 90% of that would be 18, 70% would be 14. Everyone's different. Everyone's trading account size is different. Some people trade 20 contract lots all the time, and some people trade 10, some people trade 5, and some people just feel comfortable with their account size just trading 1. So trading 1, you have a little bit different strategy because there's really no other way of doing it other than getting in and getting out completely. Okay, so later on here we can see after a brief move back up to test S1, it did not break through S1. Instead, we had this candle with this wick on top here, and it starts its move back down and then continues all the way back down to mid S2, S3 at 64.10.32. So this is basically an hour and 45 minutes later from here. At 12:44 p.m. it hits the mid S2, S3 level, 64.45. The put is now $35.53, whereas back here it was $25. Later on at 3 p.m., SPX is nearing the S3 level. It doesn't quite get there today, but when it is at this violent final candle here, on the close of that candle, the 64.45 put was 43.78. Remember, we originally bought them at 8. Okay, at the end of the session here at 3:58 to 4 p.m., this is the last candle of the day, the 64.45 put closed at $33.60. So again, after being purchased at 8. So if you held your runners into the end of the day, whatever runners you had, then that would be the price at the end of the day. Okay, so another thing just to point out here is that if in fact this was an opposite day, if this candle had closed above the bull bear key price level and we had instead started off with a bullish candle and a bullish close above the bull bear key price level from the get-go of the session, and we had taken a 64.45 call, then just to clarify, the stop loss for that would be the first mid-level below, because we're taking a long position. And if you had a tight stop loss in mind, then you would simply do the first quarter level, which is midpoint between here and here. For right now, if you're trying to figure out midpoint, the quarter level points, you just simply add these two together, divide by 2, or add these two together and divide by 2. We will be coming out with a new version of this indicator, which will have the quarter points built into it to make it easier for people that want to mark off the tight stop loss levels. So that will be coming out in the near future in a couple of weeks. Anyone that purchases the indicator, as we'll show you later on in the video, gets lifetime access and also any lifetime updates. So you pay for the indicator once, you have access to it for lifetime, and you're also entitled to get any updates over time as well that we come out with. Okay, so we'll go over this note here. 0 DTE Lotto option play window starts at 2 p.m. and runs into the 4 p.m. close. If you've accumulated profits from earlier in the session, can consider using a max of up to 10% of earlier session profits for a possible end of session 0 DTE Lotto option plays. So the Lotto option window starts at 2 and of course ends at the session close at 4 p.m. Generally speaking, it's usually better to look at the window as more of a 2 p.m. to 3:40 p.m. window, because that leaves you 20 minutes for the rest of the session into the 4 p.m. close if you're going to enter right before 3:40. However, you have to keep in mind that even though that may be what the case is most of the time, there are a lot of opportunities at the very end of the day, especially in the last 5 to 10 minutes, and some of these options can be extremely cheap at the end of the day. For example, this 6410 option at the end of the day was going, I believe, for around anywhere from around 15 cents to 25 cents at this point here, and it ended up going up to $2 at the end of the day before closing a little bit lower. So that could have been anywhere from a 4x to a 10x or even a 15x. The whole point is that you're taking just a small amount of your profits, up to 10% of your profits early in the session, for a lotto bank for that session, that if you want to stay in front of your computer and you want to watch the end of the session, and there are some cheap options that you'd like to take a stab at, which are lotto plays. And lotto plays mean that you're buying them generally for, let's say, anywhere from $1.50 down to 10 cents, depending on what time you're buying them at. And you're only taking up to 10% of your earlier session profits. That way, if your lotto play doesn't work out and you lose all the money in the lotto option play, you still have 90% of the profits from earlier in the session. That's the most prudent thing to do. It is not a good idea to take more than 10% of your accumulated profits to put towards any lotto option play, because there is a fair chance that it's not going to work out. That's why it has possible returns of up to 20x or more, because in most cases they will end at 0. Okay, so just to recap the session here before we look at the Thinkorswim charts. So we had one win and one loss. We had the loss here on this first trade, and we had one winning trade here. We have a $1,170 net profit on the day per contract. We have two trades, both using the 64.45 put, and both using the entries on close below the bull bear key price level. Trade number 1 was taken on the initial 9:30 candle close. That cost was $10.60. So that's $1,060 per contract. We got stopped out on the 10:02 a.m. candle. the low price of that candle. So we're just going to assume the lowest price of that candle was where you got stopped out at, was $5.30. So that's $530, which just turns out to be 50% of what we put in, 1,060. So it's a loss of $530 a contract. Trade number 2, we paid $8 on the close of this candle here. So that's $800 per contract. 24 minutes later at 11 a.m., the candle hit the S2 target. The exit price on the S2 target was $25. That's $25 is the close of this candle here, as we'll see on the thicker swim chart. That's a profit of $1,700 per contract. Because at $25, that's $2,500 per contract minus our $800 cost. So we have a net profit on the day of $1,170, $1,700 profit per contract minus the initial $530 loss on the first trade. If you're trading one contract, that's $1,170 profit, 3 contracts, $3,510, 5 contracts, $5,850, 10 contracts would be $11,700 for the day. So for example, if you were trading one contract, then you would take a maximum of $117 as a possible bank to look at for buying lotto option plays. If you were trading 5 contracts, you had $5,850 profit, then you would look at taking up to 10% of that, which would be $585 for lotto plays. If you had 10 contracts with $11,700, then you would have a max of up to 10% of that, which would be $1,170 for possible lotto plays. Alright, so now we're going to look at the thinkorswim chart. 64.45 put. Here is our 9:30 entry candle here. As you can see here, the close of that candle is $10.60. Here is the 10:02 candle in which the SL was hit. As you can see here, it opened at 770, had a high of 780, a low of 530, and a close of 560. For purposes of figuring out the net profit, we're just going to use the low of this candle and assume that you were stopped out on the low of the candle at $5.30. Here we have the re-entry candle at 10:36 where it crossed and closed below the bull bear key price level again with confirmation. As you can see here, the close of that candle was 8, which is the entry. As you can see here at 10:50 a.m., SPX hits the S1 level. So there we have a close of $15.52. I believe on the chart we marked off this $15.50 to round that out. Here's the 11 o'clock candle, 11 a.m. As you can see, the high of this candle was $26.78. The close of the candle where it did actually hit the S2 level, it closed at 25. It did briefly spike through it, so the high here was $26.78. So for purposes of the profit, we're taking the close at 25. And then if you left any runners, here was the 12:44 candle where it hits mid S2, S3. As you can see here, the close $35.53. Here's the 3 p.m. candle, the low of day, where it just missed the S3 level. And here we have a close of this candle here at 3 p.m. of $43.78. The high was actually made on the next candle after it with a high of $44.70. And here's the closing candle from 3:58 to 4 p.m. So this is a 2-minute chart, just to clarify. So the closing price, $33.60. So if you did leave any runners just to run through the end of the session, that would have been the payout at the end. Okay, so to purchase the SPX daily key levels indicator, you simply go to www.wap.com/XPX indicator. As you can see here, we have a $500 for a one-time purchase. That $500 is for lifetime access to the indicator. It also entitles you to receive any updates that we come out with later on. We do have plans to make several updates to this indicator, one of which I went over earlier in the video. Also, as you can see in the video description, I put a link to this particular purchase indicator link, and you can also email us at daytradinggps@gmail.com, and you can request a promo code for taking the time to view this video. We will give you a discount promo code that you can use towards your purchase of this indicator. Just simply email us at daytradinggps@gmail.com to request that promo code.